Let's look at the disadvantages of equity funds. We want to explore the downsides of equity fund investments. Number one is market risk. Yes, the market risk is always there, is part and parcel of equity fund investing. So equity funds, are subject to stock market fluctuations, which can lead to significant losses, especially during market volatility or economic downturn. In a typical bear market, you discover that investors in equity funds would experience a kind of sustained losses. It is an aspect of this fund that we cannot afford to ignore. The market risk is always there. Number two is high volatility. High volatility. Volatility is part and parcel of the market. It's not something we can avoid, but it's something we have to we need to live with. And stock prices can be highly volatile in the short term, affecting the net asset value of equity funds and making them less predictable than other investments like bond funds. Because the price of the constituent equities in the fund, fluctuates a lot. That will affect the overall net asset value of the fund at the end of the day. So that high volatility, it negatively impacts the net asset value of the fund. Number three is there's no guaranteed returns. Unlike fixed income instruments like bonds, like commercial papers, like certificate of deposit, when it comes to equity fund investing, there's no guaranteed results. All right, there's no guaranteed returns. So unlike fixed income instruments, equity funds do not offer any guaranteed returns, as their performance is tied to the performance or the condition of the stock market. If the stock market does well in a year where the stock market does tremendously well, discover that equity funds will will have an outsized kind of returns. In a case where the market performs poorly, but the fact that equity funds invest in the market, it will certainly affect the performance of these funds. Number four is management fees. Management fees. You discover that equity funds are particularly, those that are actively managed, charge management fees and expense ratios, which can reduce the overall returns, of the investors, especially if the fund underperforms. Whether they perform well or not, they will still charge their fees. The expense ratios, they keep on charging these fees and expense ratios. And so in a case where the fund underperforms, discover that the returns may be discouraging. Number five is tax implication. Tax implication. Gains from equity funds may be subject to capital gain taxes. That is it. Particularly if it's, the investment is sold within a short time, it will attract a high level of capital gain tax. And so, the more you churn the portfolio, the more frequency of the trade you carry, the fund manager carries out in the portfolio, the more it attracts, capital gain tax. So that on its own will then eat into the overall returns, the final returns of the fund itself. Please then subscribe to this channel and like this video. Number six is our potential for underperformance. Potential for underperformance. Actively managed equity funds may underperform their benchmark, their benchmark indices due to poor stock selection or market timing by the fund managers. And this aspect is really true. It's true because statistically speaking, a vast majority of actively managed funds, these fund managers, they hardly ever beat their index. And for those that do, they don't do it regularly. That's why people are flocking to to passively managed funds like Vanguards and other funds. They are running away from active management. They are running into passively managed funds, low fees, at least they'll be able to track the benchmark. Number 7 is sector and geographic risk. Certain equity funds focus on specific sectors or regions, which can lead to concentration risk if those sectors or regions experience downturn. If the sector you've bought the securities from, undergoes, a kind of downturn, it will affect the stocks. If the region you've kind of invested in, experience instability, then of course it will equally affect, those stocks, and that will affect the funds negatively. Number 8 is limited control. Investors have no direct control over the stocks chosen or the timing of purchase and sales, which can be a drawback for those who prefer hands-on approach. If you want to manage your own portfolio, then you should not be in an equity fund or any other fund for that matter. Go to the market and buy your shares yourself. But as long as you are in this fund, you are rest assured that you will not have any control over what happens. The fund manager does his research and analysis and pick stocks he believes will perform better in the long run without your inputs. You don't seek your input at all. Number 9 is liquidity risk in extreme conditions. Although generally, liquid, they are known to be liquid, and equity funds might face liquidity constraints during severe market downturn or crisis, potentially delaying withdrawals. Although they are known to be liquid, highly liquid, but in certain environments, in certain, economic conditions or market conditions, you discover that you may not be able to very easily sell your holdings and recover your money. All right. So that's particular factor should be considered. Number 10 is emotional stress. Emotional stress. The volatility and potential for losses can lead to emotional stress for investors, particularly for those who have a natural low risk tolerance. And during a market downturn, it might affect the investor kind of psychologically. It's painful, seeing your investment drops drastically, particularly over a short period of time. It leads to a kind of panic. So these disadvantages highlights the importance of aligning equity funds with an investor's risk tolerance, financial goals, as well as some investment horizon. So have the capacity to bear risk. That is a very first consideration. You should consider if you want to invest, in equity funds.